Sorry. Now, still your host, Yanandi Murua, Price Action Traders. You're welcome. So I wanted to start a series for those who are still new. I have a lot of DM on my, a lot of chat on my DM telling me to maybe to enlighten them, create awareness about this support and resistance. It's not support and resistance is not really, this is from the Malaysians as others perceived. The Malaysians just come, maybe just come in and, redefined, maybe introduce some certain things. Which not introduced, revealed some deep knowledge about support and resistance. So support and resistance did not really start from the Malaysians. Support and resistance has been from the day old of the Japanese traders in the 12th century. Technical analysis started from the Japanese, so not the Malaysians. I'm trying to discredit the Malaysian. Thank God for making it like a kind of a distinct, but then it has been there. So it is only being pronounced as in made relevant by the Malaysians. Yeah. So support and resistance has been from the day of the very first start of the technical analysis in Japan, when they use it which they use for their rice trading by a legendary man named Sukihoma. Yeah, Sukihoma started the technical analysis in Japan, then passed down to the West from Japanese down to the West by a man called Stephen Nissen. Yeah, he translated the Japanese language in technical analysis to the English language, and then from there we had the feel of the candlestick. Yeah. So the father of technical analysis really, they are the Japanese rice traders, yeah, who started the knowledge of technical analysis. So the Malaysian really, they are not the originator of support and resistance. They just evolve it. Kind of shed more light into it, what has been in existence. So there's nothing new. It's still the same thing as of old. Yeah, God bless you for having that. So let your heart not be pounding, let your heart not be deceived, don't be deceived by any times you see any new times you see the same thing as old. It's just a little, a kind of they shed more light into it. Yeah. So now we want to talk about liquidity, because then if there is no liquidity in the market, there can't be support and resistance. That is the first thing. Liquidity is most significant to support and resistance. So you cannot do without liquidity if you are to trade support and resistance, because that is where the bulk of orders lies. That is where the eyes of the institutions, that's why the eyes of the institution lies. They don't have business of maybe implementing one trading plan or thereabouts. All they do is to trade off liquidity at this level of support and resistance. And what is liquidity? Liquidity is simply a bulk of orders. A bulk of orders. Sell or buy. Somebody is selling while somebody is buying. That is liquidity. So when we say market is so liquid, the market is full of orders. A standby order. So if you want to, and I really want to appreciate the Malaysians for this kind of knowledge light they have shared more into this because we have been used to trading support and resistance, in an old conventional way, using the week, the low of the week, and the high of the week to trade resistance there. But thank God for making it more relevant to focus on the body of the candlestick, because the body of the candlestick is where the volume lies. Yeah, volume is more significant than the week. The volume is significant in trading. Volume, amount of transaction, quantity of transaction that is being traded per trading session. Volume matters a lot, and it determines the direction of the market. Volume. Yeah. So, what is liquidity to SnR? Liquidity, I told you, lies above resistance and support level, below support level. Yeah. So there's liquidity at the support and resistance area. So if you have to understand the language of the candlestick, how candlestick is formed, how price is being how price moves in and out of support and resistance. But before then, let me show you this a golden word from my great mentor, legendary man in the market by the name Richard Wyckoff. Wyckoff has been one of the market movers in the past. Had been one of the market movers, He's died down, but the legacy still lives. Legacy still lives in the financial market all over the world. He has raised, millions of followers. Yeah, like some of us, we have learned a lot from him about manipulation of the market. Yeah, so starts from the yeah. So hear him talking about the manipulation, how liquidity brings about or liquidity give rise to manipulation. Liquidity will always exist, and therefore so will be manipulation, according to Richard Wyckoff, one of the legendary traders. Wyckoff proposed a heuristic device. He called the market makers as the composite man. That all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operation. Let us call him the composite man, who in theory sits behind the skins and manipulates the stocks to your advantage. If you do not understand, take note of that word. If you do not understand the game as he plays it, and to your great profit, if you do understand it, to your great profit, if you do understand it, that's Richard Wyckoff in his manner of, stock market science and techniques. So he, in fact, he will claim that it doesn't matter if the market moves are real or artificial. That is the result of actual buying and selling by a public and bona fide investors, or artificial buying and selling by larger operators. So you must understand how the game of manipulation plays out, how the game of manipulation plays out in the market. That is it. You must understand them, so that when you know the right particular moment of that manipulation, you know the next direction. This is the basis of my previous course of AMD, which is accumulation, manipulation, and distribution. That's once market ranges is accumulating the highs and the lows of the market, the liquidity and the lows and the the highs of the market. Then after manipulation, what happens? Distribution of profit into the opposite. That is what happens next. So that's what controls the market up and down, manipulation. And if there's no liquidity, there can be manipulation. There must be liquidity. Because markets markets search for liquidity up and down and manipulate it, against the retail traders, the investors. I mean, the institutions, their investors manipulate the market against the retail traders. So you don't want to be in the side of retail trader, but you want to be in the side of what? The side of the institutions. So you trade along with them. Trade along with them. So in that regard, you want to hear this word from this man. There are those who think they are studying the market when all they are doing is studying what someone has said about the market, not what the market has said about itself. So I've had a lot of chat in my DM telling me this and that doesn't work, this doesn't work, blah blah blah, different stories. People jumping from one this into the other. Looking for what works, 100%, looking for holy grail. You see, life is about what you learn by practice, by experience, what you learn, what you get by experience. It's not really, though it's good for somebody to tell you something, but at the same time, your personal account. Yeah, it's a faith thing. It's a faith thing. It's about how you make use of what you have learned, and then how do you see it? How do you view it in your mind? Your perception creates your reality. Yeah, how do you see it in your mind? You expand what you get from somebody. You have a piece of an information, and you now expand it in your mind. You apply it. You see how it works out, how it plays out in the mental image first. Yeah, then before you now transfer that into the chart. That is the way of learning trading. You must form the meta image in your mind, how it plays out, understand it in your own language, translate it into your own language, let it create a meta image in your heart, then transfer that into the chart. Yeah, you see it evolving now and then, patterns. You must be able to recognize this in a chart, patterns. Ability to recognize pattern, pay attention to details in a chart works well so much. That is what this man is telling you. You trade what you see. It is not what you bring from. It is not that whatever they teach you in the class, or whatever you read from textbook, or whatever you get from one website, that's what will work always. No, it doesn't really work always like that to your own expectation. So if market changes its algorithm, or if market changes its movement, or this thing, then you change with the market. That's just you must learn to adjust, your lens of, say, the market from the perspective of liquidity and from the value of the institution. Yeah. If they change the market, the algorithm, then you change you adjust your lens. You adjust it. So that's why I put this course as a beginner, just to enlighten your mind about the who's and the cries of this Malaysian Support and Resistance. If it's a new team, people are like, blah blah blah, doing wrong things. No, there's certain things you must understand, which will hold ground in your mind. Now, this is a candlestick. How does it happen to be a bearish candlestick and a bullish candlestick? If market opens here, that means it must look out for liquidity. Now, to the market search for liquidity up and down. It must look out for liquidity above the previous day close, if it's going to distribute profit downward, because you buy low, the institutions will buy low, they will always negotiate for low price and sell and push price of autos to sell at a higher price to retail trader for a profit, right? They buy low from the from the market, from me and you, who are selling at a lower price. Then they buy low, they negotiate so they bid for the price at the lower price, and they move the market upward to sell at the higher profit. So if market opens like this, that means what you see is that it will go up to create the high of that session, and then manipulate those stop losses above the resistance, or at the resistance level, or above the high of the market. Then what happens? That is manipulation, right? Then distribution of profit will start coming down from the opening downward. That is that distribution. Then to create the low of that particular session, either close here or close higher. So this becomes the close of the market. Can become the close of the market. Close of the market. So if that is the close of the market, this is the low. This is the low of the market. This is the low of the market, and this becomes the high of the market. You can see that. So what I want to reemphasize here is that the highs and the lows represent the upper wick and the lower wick, the lower price rejection and the higher price rejection respectively. The high now, that means the buyers, some little buyer push the price upward, then sellers displace them off. That's displacement, an act of displacement from the market, which is the manipulation, right? So that means from here to this place represent what? It represents higher price rejection, while here the sellers push the price down, selling here, then they bought low. Now some part of them push the price up for a profit taking. So the price, the number of sellers that comes down to this place to buy low has been displaced upward by few buyers. So this means from this low to this level represent what we call a lower price rejection. So the upper wick and the lower wick represent the what? Represent the phase of manipulation. This is displacement or price rejection. So the body now, this is the volume. The body is the volume. From the opening to the close is what matters, at the end of that trading section. From the open to the close, that is where the Malaysian got their distance. So the liquidity at that resistance level has been taken off, then price distribute profit lower. Distribute profit lower. That means they are coming to sell. Sorry, they are coming to buy at the lower price. Then after they push the price upward again. So if that is not, because they are still negotiating for a lower price, if that is still not enough for them, that means they can still push the price according to their the influence. They can still push the price below. It is in the next session. That means they can still push the price below where they close to open here at a new resistance level. It open here, then price comes down to close. To close here. To close below the opening price. So this becomes the close of the new session. So you can see that the support here, which is this support. Let me. So this becomes the opening price there become the opening level become the resistance, not the high of the market anymore that we used to perceive it. So the opening of the market becomes the resistance, while the close becomes what? The close becomes the support level, become the support, right? Become the support. So now, as this price open newly, then it will go up again. It will go up again. That's the rule of manipulation. Then to close down below the opening price. Then you have another close like this. So you can see that where the issue of open and close, which the Malaysian try to focus upon, arises. This now, because this support now is transferred into a new resistance as price close lower. It become a new resistance. While this is a new support. This is the new support. This is the new support. So if they have the power, the seller have the power to see push price lower, to bid price lower, right? They still have the power to bid the price lower than they close. So you can see that. So that's how manipulation happens up and down, and that means liquidity lies. So the expectation of this now is for price to do what? Because in other time, if this price is going to come down again, if they still want to push the price lower, they must go up there and take liquidity off this resistance level, like it did here. It will go up, take liquidity, then comes down. This one too will go up here. It will go up, take liquidity, and then continue downward. This because the liquidity lies at the level of resistance and support. That's why you see price moving to each level of that resistance or support, and either reject it or break out of it. So the opposite is what happened on bullish market. If price opens below, it opens here, it will now create a kind of low to manipulate downward to create the low of that particular session, then moving up to create to close high or close a little lower below the high. Yeah, so that becomes the close of the market for that particular trading session. This becomes the open, this becomes the low. So this is also known as the support level. We only create the support level and not the low of the week support level, because we are dealing with volume now. So then the close becomes the resistance of that, the resistance of that trading session. So the second day, the second session where price will open, the second session price opens, it opens here, and place again, look for liquidity at the support level. At the support level, then trigger it off, move when they distribute profit into the opposite and close either at the top there or coming lower to close. So this becomes the new opening. This is the support. The support, and then the This is the close, which is the new resistance, which is new resistance. That's how price moves along the line of each candlestick. So now, so that means at this level of each support, the support level, it lies a liquidity here. As the market move to credit to close to move after the manipulation, they move upward, right? That means there are still some liquidity being seen here. So they move lower to take out this. At the opening of the new candlestick, what market does is to move lower, here and then push the price upward, manipulate that support. The liquidity that is existing above below that support level and push it higher. So there are some people that place their stop loss here while they were buying. So the markets will come down, trigger off the liquidity, the buying order, that the stop loss order. Then they move the pricing into the opposite because you are telling them to come and buy from you at a lower price. Here they are selling to you at a higher price. Yeah, this is selling to the retail trader at a higher price. That is how price move. So that is what you see here up and down. It's what you see here up and down, up and down, up and down, up and down. So that is for liquidity and SnR. So for you to say liquidity does not exist in Malaysian support and resistance, it is liquidity that makes up the Malaysian support and resistance. That's my conclusion. It is liquidity. So you must understand the language of liquidity, how liquidity is being taken off the support and resistance levels. So if you are a beginner, so if you are new to this Malaysian concept of trading the support and resistance levels, you must first understand the language of liquidity, how market travels, along the path of resistance and support. And you must understand the language of liquidity. So if market opens, it will first come down to trigger off the support. This is the support, right? Trigger off the support, then distribute profit into the opposite. If it happens to be the resistance, market opens here, see it? It opens here, trigger off. Let me do like this. So if this is the resistance of the market, where market closed, then the next open will be to trigger off the liquidity that exists because people place their stop loss there. They are coming. The decision has moved price earlier on, moved price from this level, low price level, then taking it higher to sell to the retail trader at a higher profit, at a higher price for a profit, right? That's this after distribution of profit is sold out. So they are coming down again to take order from this particular area. So, but this is the support level. This is support level. This is support level. This is the resistance level. So if market opens, it will trigger off the orders that of orders that exist above that the resistance level, at the resistance level. Then trigger it, see it. To come to trigger it, then got rejected. And see, so distribute profits, trigger it off took out all the orders of that exist above this at this resistance level, then move down from them, moves down to to distribute profit to the opposite, downward. So that is what happened. If it happened to be a support, if it happened to be support, that means price would, if this is support, if this is support, or previous candle things of support, the price will come down here, trigger off this, and then distribute price into the opposite. Distribute price to the opposite. It's monthly. You can see that. So trigger off this, the support level. Here, resistance is checking out here. Then price come down, distribute to the downward, then attack a new level of support here. I mean, reach the new level of support here, then got rejected, and what happened next? So distribute profit to the upside. That's what happened. So that is the language you must understand about liquidity, how liquidity exists at support and resistance level. So without liquidity, there is no support and resistance level. You must understand the language of liquidity. And what is liquidity? Liquidity is the bulk of orders from retail traders placed on support and resistance level above resistance, the below support level. That is that. Bless you.